Good evening, everyone. A very warm welcome to all of you to this special session on Integrated Business Solutions paper organized by Board of Studies Academic. Students, keep in mind this paper is not difficult, but for this you must have proper planning and proper strategy. Students often say, we have already cleared group 1. Why do we need to study again? You students, you have to appreciate that in today's dynamic world, you cannot take decisions in silos. You have to take decision in a holistic manner. A single decision is connected with others. For example, suppose you are operating in a matured organization or matured industry. Now the question arises, how will you increase the profitability? Now you have two options. Either either take market shares from competitors by adopting aggressive strategies like market penetration, or think differently. Instead of acquiring competitors, you may decide to optimize your value chain or supply chain by removing non value added activities. Okay, therefore it is very important to look on your value chain and your supply chain. At the same time, you may also have to think strategically. To optimize your supply chain, you may either acquire your suppliers to have better control, or go ahead and open your own distribution channel. Here, strategic decisions play a key role. Suppose you choose backward integration and decide to invest in acquiring a company in South Asia due to cost efficiency and proximity to global hubs. Say you want to invest in a neighbor country like Sri Lanka or Bangladesh or Singapore, any other country. Such a cross-border investment align with FEMA provisions. You know, under FEMA, if the proposed investment exceeds 400% of net worth, it would require prior approval from RBI. Now see how this strategic decision is connected with local compliances. It is important to note that strategic decisions cannot exist without the compliances. Once regulatory clearance is obtained, the next decision will be funding. There may be decisions to raise funds through foreign currency loans, that is external commercial borrowings, domestic debt, equity. Suppose here, if you opt for foreign currency debt, you must hedge against exchange rate fluctuations since the rupee is volatile. If you choose domestic debt, then the debt moves from fixed versus fluctuating rates. Therefore, you have to think from the financial AFM, your AFM subject perspective also. You must appreciate that in a rising interest rate environment, floating rate loans could lead to cost uncertainty. In such a situation, entering into an interest rate swap to convert floating rates into fixed rates may be a prudent decision to reduce volatility. The further these decisions may also have custom implication because this is you are going to have international transactions. Okay, the key takeaway is that the strategic decision must be assessed not only from operational feasibility but also from financial wisdom and regulatory compliances. This involves thinking like CEO, considering the strategic alignment, financial optimization, and regulatory foresight, especially in sectors where margins are thin. And external factors like fuel prices and currency fluctuation can be significantly impact your strategic decision outcomes. Therefore, this subject is based on a holistic approach. Now let us discuss practically. In this group, you are making your the subjects DT and IDT, direct tax and indirect taxation. Now change your mindset. Change your mindset. Assume that you are preparing for 4 papers. Why I am saying this? Picking one or two paper from group 1 and study them thoroughly. Pick 1 or 2 papers from group 1 or 2. This will not only help in clearing your exam but also help you in your professional life, especially subjects like financial reporting. In addition, try to develop the conceptual understanding of the remaining subjects. Only if you have good conceptual understanding, you can effectively use your open book resources. It will be very helpful during the exam. Now, so students, to use open book resources effectively, basic conceptual understanding is must. Again, I would like to say approach this exam with proper planning and proper strategy. Let me give you one more example. Students, don't take set A or and B seriously. This is major mistake. You are aware that the first step is strategic decision making. You cannot apply strategic decisions without understanding them. And this understanding comes from where? It comes from set B. Similarly, in today's environment, corporate governance is extremely important. Without it, long-term survival of a company is very difficult. This applies to every company. You are likely to get questions from this area. This includes topics like appointment of director, remuneration, women director appointment, independent director, board meetings. Ignoring set A and set B are it means you are clearly losing 35 marks, which is equal to 30% weightage. Similarly, if company is having foreign operation, you may get questions from Forex, AFM subject, custom duty from indirect taxation, FEMA from law portion. If the company is listed, surely you will get question on SEBI LODR. If the company is in pharmaceutical sector, then intangible assets under Ind AS 38 is very important. Think from this perspective. Ind AS 24 on related party disclosure is very important, not only from a financial reporting perspective but also from Companies Act as well as SEBI LODR. All the case study material is available on students portal. I encourage you to review the material thoroughly. Today's session will be interactive, so please free to ask whether in Hindi, whether or in English. You can speak up or type your queries in chat box. Additionally, the last 10 or 15 minutes will be reserved for your general queries. Okay, that may not be directly related with your today's case study. We are fortunate students, we are very fortunate to have CATV Bala Subramanian sir, a well-known chartered accountant. He is currently partner in PKF and having outstanding experience in statutory audit. Sir is active management consultant on project feasibility, business plans, structuring, apart from handling numerous merger and acquisition assignments as well as internal audits. His expertise will help you to connect theoretical knowledge with practical knowledge. With this, let us begin today's session and explore this and explore the insightful business cases. Sir, TV Bala sir, over to you, sir.
Thank you. Very good evening to all. First, let me share the presentation and then we can take it forward from there. Uh, yeah, yeah. The presentation I hope is visible to all. Once
Yes,
again,
sir.
very good evening. So today we are going to be looking at two case studies, and as he was mentioning, after the case studies, there will be some time for some question answers so that you can also get some general queries which are in your mind addressed. In the meantime, in respect of the case studies which we are going to be looking at, also, if there are anything, you can ask and we can put it together. Uh, Now, the first case study which we are going to do is a case study of how a company went into a huge crisis. From there, it became a leader later. So, this is a lessons we are learning from DN's demerger, turnaround, and market expansion. This is also partly based on something which happened in India. Of course, we have ensured that there is absolutely no specific reference to any company. So the whatever you are seeing are all not things which are only from a book, but basically these are some things which happen in day-to-day life. And as Gupta ji was mentioning, it is very important for us to understand that most of the time decision making in companies are based on multiple parameters and not a single thing. So that is where I think the subjects like or papers like IBC becomes very useful. So let me take forward the first case study. Now, this Deccan Engineers India Limited, this is not an actual company which is existing. It is just a synonym. We have just given a name for the this thing. Deccan Engineers Company India Limited was part of a larger group, Deccan Group, and it's over 150 years old, right? It was started in the 1800s, and it's one of the enduring industrial branch which have had been there. 150 years is not a small period, and to maintain your brand through a long period like that is a significant issue. Now, originally, when this was established, it was a pioneer in electrical engineering. The company soon became a household name in India. It was synonymous with reliable fans, pumps, lighting solutions. For many decades, it built a strong brand image and deep trust among its channel partners and consumers. So the name of Deccan was so well established over the period. The company started modernizing and it also moved into in the post independence era when it was acquired by another prominent industrial group, the Deccan Group. So it became a very large entity and part of a large group. And in the 20th century, it was expanding into a diversified conglomerate involving. So, what I was into some household equipments kind of thing and maybe some industrial small equipments, etc. From there, now I moved on to power systems, industrial motors, and various consumer products, also global footprint, right? All this was being taken. So, with all that kind of a growth, unbridled growth, right? Aggressive expansion. Now, it was all also capital intensive because these power and industrial solution businesses require a lot of investments to be made for every new product, new lines to be brought in. This led to a very bad financial situation for the company. By the time the company came to 2010s, the parent company was in the verge of bankruptcy, burdened with a staggering debt of over 7,500 crores. So by then, they had got into deep financial difficulties. The consumer business, which included profitable and well known products like the fan, pumps, lighting, which was coming from long off, was supporting, because this was making money, was supporting the ailing B2B divisions. And because the money which it was making was going towards B2B divisions, there were poor reinvestments into the core original business of fans, pumps, lighting, etc. Unless you keep reinventing and reinvesting to ensure that you are in the right place with the right technologies, everything being brought in and updated, businesses cannot survive for long. So, by 2014, the whole group was in a very shaky position. So, what they did in a pivotal move, a major move to stave off complete collapse, the parent company decided to sell its crown jewel. So, what is this crown jewel? The business of fans, pumps, lighting, which was coming from donkey's years, 150 years. Now, that is what had actually given them all the money for the expansion they were going into. But the expansion did two things. One, it put them in a precarious financial position. Two, because the money was being moved to these businesses, the core business itself was not well reinvested and modernized to the 20th century or the 21st century requirements. At one point of time, what was the number one brand or equivalent of a number one brand, well known brand, etc., was not having itself modernized from time to time to retain its position there. So in 2015, when the company wanted to sell, who bought it? There were a consortium of private equity players who bought the significant stake in the business. And they made it into a separately, professionally managed entity. Now, this demerger from the group into a separate entity was the starting point which led to a significant growth and change turnaround for this company, particular company. So, what was a neglected but a valuable brand from the past, which had then become financially riddled with problems? Now, after this demerger, it was made into a debt free, again moving towards becoming a market leading consumer durables company. This is the whole journey we are going to look at, and what came up and what issues were handled is what we are going to look at in this particular case study. Now, let's go and look at the business model and the core operations of the entity. Dieng. Dieng's business model is centered on designing, manufacturing, and marketing a wide range of consumer electrical products. So, it was focused on consumer electrical products, which means basically it was also essentially a B2C entity. B2C entity. The company operates was into two broad segments: electrical consumer durables and lighting. The ECD segment was including fans, pumps, residential wires, and very many domestic appliances, right? So even the pumps here are basically pumps which are more for the residential or such similar smaller use. It was not focused on the industries. The post the merger, what is the strategy they were looking at? They focused on transforming a underinvested business, right? Because we were seeing that because the money was short, the company was not able to fund for everything. They were looking at a scenario where they were not investing into these businesses on a continuous basis. So from that, what they moved it into, they made it into a lean entity which was focused on innovation, and significant operational efficiencies were being brought in to become the market leader. So the company before its demerger, because of the expansion into various other businesses, the parent entity from where it got demerged, that parent entity was capital intensive. It required huge capex to be spent because of the significant diversification and expansion into the other areas which were more B2B business which was being done. As capital was also limited, the focus of this demerged entity was clearly on having a different strategy of brand building, innovation, and distribution. So, not necessarily manufacturing, right? So, this is the way they approach the issue. Now, individually looking at each of this, one of the key things in the company was product development. And this product development was driven by a consumer led innovation strategy. So, what would be of interest and use to the consumer? Find those. The company was investing heavily in R&D. So, whatever was not done for so long, now to catch up, it was invested into R&D with a dedicated center of over 200 experts and annual innovation spend of about 100 crores. So what happened from just doing some continuous products of what has been done in decades and decades? Now they started to deliberately shift towards portfolio premiumization. What is portfolio premiumization? Bring in new products which give you better margins, better this thing. So you sell the same fan, every fan is selling the same. You are also selling one more fan, and somebody buys a fan, they buy a fan. They are not going to buy two fans just because your fan is better. But if you can bring in advanced offering in the fan itself, then your value proposition can go up and you can get significant benefits from that. So they focused on bringing energy efficient fans, and the first time in this industry as a concept, idea first series for kitchen appliances. So you have an idea, we are there to deliver something to do that. So the whole approach was to make the consumers get a different experience and a much heightened experience. So what they would normally go in for, they go in for a premiumized product. This was one significant thing they went and invested on instead of just trying to expand distribution, trying to expand manufacturing, and working on cost arbitrage and things like that. So very strategically, they said, let's see how we can make premium equipment. If a fan normally sells for X rupees, can I come with a fan which will sell for X plus 20%? Then the same fan which is going, the number of fans which are sold would probably be the same. That is not going to significantly change over a period, right? But it can give you additional value proposition, better margins. Okay, this was the one first thing they looked at, one direction. As I said, brand building, innovation, and distribution. The second part was the marketing and distribution. Now, the company had a strong brand legacy. It is not new. And because of that, it had already a very good distribution network. So, what did they do? They looked at the go to market strategy and revamped it to enhance penetration into traditional retail, right? Because a lot of these are sold in traditional retail companies, and also slowly e-commerce and modern trade are taking over these lines. So they looked for enhanced penetration in the traditional retail. So the first one was to improve the margins. The second one was to increase the numbers while simultaneously deepening its presence in high growth channels like e-commerce and modern trade. These are the new things which were coming. Also, there was a significant rural acceleration program they took up. How to reach into more centers. That is where market is not fully tapped. So there is a potential to tap more. There is a potential to keep adding to your volumes. So this is what they did from a marketing and distribution perspective. So simultaneously, they also noticed from their product development approaches or research that there were gaps in their products. So there are certain products which they were not having. So one of the things they did was to do some strategic acquisitions to fill such gaps. You had two choices. You can do your own research, come up with some product, and then go and hard sell it, and then slowly build it, etc., and reach a level which takes time and efforts, etc. So sometimes there is an opportunity to acquire something which is readily there and grow it. One of the most significant acquisition they did was in 2022, where they took a 75% stake in Carnatic Kitchens Private Limited, which was a well-known South India-based kitchen appliances brand. And they paid about 2,100 crores for this acquisition. Now, why did they do this? They were more into fans, pumps, wirings, and some appliances. They did not have a full range of kitchen appliances, especially with good name, etc., readily. So, with this, they were able to bring out a larger range very quickly under their brand, under their umbrella. So, the whole suite of products now had pressure cookers, mixer grinders, gas stoves, etc., also, which were not there earlier. So, when a customer is spending on your name, how to increase that spending is to provide other things also which he will buy, but all these days you did not have it, so he was buying elsewhere probably. So this was what they did, three pronged. to take a significant jump into the future. So while they were doing all this, let's also see what kind of issues they came up with and how they dealt with it, etc. One second. I think it ran quickly, right? So some of these strategic decisions which they took at various points of time, let's look at it. The first and foremost was the demerger itself, and then the focus on operational and financial discipline to be able to grow the way and make it come back as a strong company in time over time. The most important strategic decision was to actually demerge the consumer business. If it had not been demerged from the debt laden parent, this business would have also been driven to ground along with the other division. By demerging this and transferring the stake, it liberated the profitable consumer division so that it could grow on its own. Again, all the fetters which was placed on it were removed and it grew. The private equity investors generally they don't only bring in capital, but they also bring in a lot of governance and board level strategies, etc. So they were also giving a push towards transformation. This new structure, because you have come out, you are profitable, you don't have any debt to service, etc. You have now a good professional team, new professional management, which has the free hands to actually drive this. And you have a board made up of a lot of private equity investors, etc., which brings in governance and also a lot of strategy inputs which will come from them. This enabled the company to focus building the Deccan brand in the consumer durable space. So this was the first key strategic decision which really made a huge this thing. So the new management quickly diagnosed the issues. So what are the things they addressed? The brand had been underinvested in. So I was doing the fan, which was probably the fan which was produced 50 years back. I am still producing it and selling. It will also sell, but slowly you will find that there are other brands which are doing better. You're not. I am selling pumps, which were again 50 years back, similar pump was made. I am still making it, I am selling it. But the market is having lot many other opportunities and lot many other products. The whole product portfolio was stale, because of which the competition was intensifying. So they took a immediate multi-pronged strategy, because everything takes time. Innovation doesn't happen next day. You can't say, okay, boss, now I'll form a R&D team. Tomorrow we'll have new products. It doesn't happen like that. It takes time. So while you do that, you need to do multiple things. So the first was, or one of the focus was to have intense focus on cost savings. In the first 5 years alone, the company saved 1,000 crores in costs through rigorous operational excellence programs. Now, not ordinary sums, 1,000 crores of savings in 5 years to get better profitability. It was already a profitable business by itself. So generally what happens is when businesses are profitable, they tend to become a little lethargic. And in a very large conglomerate with multiple businesses, this business was the cash cow. It was supplying cash to every other businesses. So over a period, what happens is their lethargy will increase, saying, oh, I make money and somebody else is spending that money. Let me put myself in a cushy position before they can spend it. So there is always a lot of padded things which are there. That same amount of efficiency that lean machine is not maintained. So one of the things they looked at was to focus on that and shave off costs. On the other side, they were investing into R&D to completely revamp the product folio. So without new products being brought in, you can't continue in the market forever. And by bringing in new innovative products, you can gain share in the premium fan market. So what did they do by this R&D and new products? They grew their share from 7 to 20% in 4 years. This was a significant jump. Not only they did with this thing, fan market, but in LED where they were lagging, they had not even started LED lights because LED was a new technology. They were lightings were what they were doing donkeys years back, they were doing. So by doing R&D, etc., and coming out with new products, they brought in LED lighting and caught up with the market over a period. So this is what they did in terms of innovation and premiumization to achieve better, etc. There. Then what they did disciplined capital allocation. Now they know that we have only so much money, and though we are making this thing, we need to do a lot of investments, a lot of acquisition, various things we need to do. So they were very clear what they wanted to do, right? The company maintained a sharp focus on cash flows and a strong balance sheet. This discipline enabled it to make a large strategic acquisition, which is what I was talking about, the Carnatic kitchens. Its brand was called Sparrow. And then, in a testament to its financial strength, they repaid the total 2,100 crore within just 3 years, again becoming zero debt by 2025. 22 they acquired. In 3 years, they were able to repay the loan for the whole acquisition by having disciplined capital allocation and control over cash. So these are some things they did to ensure that they significantly improved the position of the entity. I'm just moving this so that I'm able to. Yeah. So in this, what challenges they found and what kind of approaches they did, right? What were their issues and how they dealt with it? The first challenge was the financial crisis in 2014-15. Though the consumer business was profitable, it had by then lost market leadership because many years there has been no new investment, so no new product, no innovation. You are still marketing some things which were produced 20 years, 25 years back, same models, etc. So one side your market leadership is going away. On the other side, you are overshadowed by the financial distress of the group, creating significant uncertainty about yourself. Even people will be worried to stay. There, this demerger was a very, very significant response. It became a new independent entity. You had a professional management, right? So they could take clear steps, like we saw in the previous slide. They could take very clear steps towards making significant changes on all parameters, be it cost savings, be it innovation, be it distribution network. They were able to focus on it and do it. And they had no more worries about the parents' problems, so that they could just focus on their own. All these years, they were anything they were doing. The moment they had some money, there was a parents' problem which was more burning than something which you could do to improve your product profile, etc. So all that was gone. So that was one significant change. So sometimes demerging and probably hiving off could also bring benefits to certain thing. Then the second one was the integration and optimization through a acquisition. Like I said, they did some smaller acquisitions and all, but the key one was a 2022 acquisition of Carnatic, and it was for a significant sum, 2,000 crores. That was a very bold move. However, integrating the business and justifying the high valuation posed challenges. Carnatic's performance was initially not up to par, and a subsequent attempt to fully merge the entity was rejected by minority shareholders, creating an complex operational structure. You had two entities, you couldn't merge it, right? So you had minority shareholders sitting on the other entity. All that were also issues which were cropping up. So, in the context of it, okay, they said we will operate Carnatic as a separate entity, and it had a well known brand, a strong brand in the South India. So they said, okay, we will keep that brand, we will push that brand, and we will cross pollinate innovation from whatever we are doing into that. Thereby, they came out with premium products under the Carnatic brand, like the Thought First series. They maintained two separate brands. The Deccan brand was there, the Sparrow brand was there, and the portfolio was both getting updated, upgraded. So with this, what happened is that better products were being put under the Sparrow, this thing, brand, and they were able to continue to ride on the Carnatic's distribution to grow it. Not only that, simultaneously, they had their own national presence already. With that, they were able to take this into a national presence. So this way, what happened? I am taking this Sparrow brand into all India because I have the reach. And I have the innovation hub, so I am bringing in newer products also into that. With that, overall, by 2025, they had become the third largest player in the kitchen appliances on an all India basis. So there are some products from Deccan, there are some products from Carnatic. Together, they are there as one of the leading brands on an all India basis. Just imagine this. There is this Sparrow brand, which all these days they were limited to South India because they had distribution network only in South India. You have improved their product portfolio, and now suddenly you can open up your distribution network to sell it all pan India. Very fast scaling up is possible. Whereas if the Sparrow brand had to build its own pan India distribution network, it would have taken much longer. You readily had your own for your other products. So you readily had it pan India. So you had to only integrate this also and take it. It made a significant change and significant growth for everybody's benefit. The third challenge was the debt for the acquisition. This whole acquisition was by a debt. So they took 2,100 crore debt for the acquisition, which led to financial leverage. Then interest costs were increasing, right? So it is whatever said, and then there is a stress on the company. So one of the key focus they said is debt reduction as a strategic priority. They had strong cash flows. They also improved their cash flows. How can you improve cash flows? You can do many things. Like, for example, you have premiumized your products, your margins have gone up now. So you can replace debtors period with some cash incentive for early payment. So reduce the debtors requirement. So which means you are releasing cash, right? You can negotiate for, because you are increasing in volume, especially for Sparrow, you have significantly increased the volume after you took over by taking them pan India, etc. With that volume, you go and negotiate with your suppliers for enhanced credit period, again releasing cash. And by the enhanced sales, by taking the Sparrow products all India and selling everywhere, increasing sales, so obviously the margins increase. So overall, the cash flows increase significantly, and with those steady cash flows, they were able to meet the complete payout, which in the normal course wouldn't have been possible without these strategic efforts being taken to achieve that. And with this, what happens? You have made yourself again net debt, zero debt. You have reached a position where your cash flows in future are available for further investments, further innovations, etc. So coming to the market position, how it went through, etc. DN holds a leading position in India's consumer durable market. It is the market leader in fans and residential pumps, and it was holding a second strong position in water heaters. And it is one of the top four lighting companies in India. And as I was mentioning, through the subsidiary Carnatic, the third largest player in the kitchen appliances business. So everywhere it is in the leadership position somewhere. It has built a robust distribution network, and because of which it is continuously gaining market share. So their future growth plans are on the following lines: brand building, right? So the first one is brand building. You need to ensure that you have your brand well known, visible, reputation, etc., being set to it, right? The focus there was strengthening market leadership in the core categories, and also at the same time scaling high potential areas like kitchen appliances and solar solutions. That's a new thing they were looking to get into, right? Everywhere, there is also now solar equipments which are coming up. Product premiumization, I already spoke to you about it. So that was another pillar. Innovation and capability building. Innovation, we saw about the investment into R&D for improved products, right? And to enable that capability building, they took a huge team, 200 people, R&D center they set up, etc. Then the go-to-market transformation, revamping the distribution to enhance market penetration. So what all they did? Look at it: brand building, portfolio premiumization, innovation, and GTM transformation. So in enhancing market penetration, it is geographical also. So move more into rural. Simultaneously also grow your digital channels and deepen your existing traditional retail formats. Because the traditional retail formats in this line of appliances market is still a significantly large portion is held there. So you can't but focus on it. So, as I was saying, one of the new things they got into was the solar business. The company secured large EPC contracts, including a 445 crore order for solar rooftop systems in Andhra Pradesh, positioning itself as a key player in the renewable energy push. So, this is a new line, right? With all this, the company demonstrated strong growth with consolidated revenue increasing from 1,868 crores FY16 just after the merger to over 7,300 crores in 24. Look at the kind of size they have been able to scale up. With that, they have become zero debt, strong cash flows, and because of the strong cash flows, they have a solid foundation for a long term growth. Now, just recap on this. In 2014-15, the company was in doldrums. This business would have sunk and probably would have gone to IBC and probably be, sold to somebody for pittance, or the factory would have been let to rot and then sold as whatever. See the transformation which has been brought in by a strategic decision to demerge this and sell it, because people saw that there is value which can be grown. Both from those who demerged, the parent company owners who demerged this and sold it to the PE investors, also saw that there is a potential to do this. That's why they sold it, because they could get money to settle some of their existing problems and all that, while the other side saw a significant business to grow it also. So look at how a market research talks about this at different points of time. FY16, when the company was in just demerged stage, right? So context was, it was recently demerged in very early stages of turnaround. Revenue was 1,868, PAT was 106, debt status was low and manageable because this business by itself did not have debt. The strategic focus at that time was on turnaround and cost savings. We were talking about the initial this thing. And key growth drivers were innovation in fans and cost efficiencies. The recommendation at that time was buy. On what basis? Turnaround play. That they will turn around and make it good was the rationale for buy. Now, in 24, just before the completion of repayments, etc., it was post acquisition. There was focus on integration. We also saw that integration had some issues. Revenue had grown to 7,300 crores. PAT had grown to 441 crores, but they had an elevated debt. Some 2,000 crores acquisition debt they had taken. The strategic focus at that time was on acquisition integration. The key growth drivers were Carnatic acquisition and market share gains. So the Carnatic acquisition, how it gave growth? By introducing new products there, A. B, by taking that up on a pan-India basis. So at that point of time, analysts were looking at it and were saying, okay, if you have shares, you can hold it, right? While you are awaiting delivery, deleveraging and synergy benefits. But they were not strongly recommending at that time to buy. They said, if you have, you hold. No problem. In FY26, post all this, it has become zero debt. It has premiumized already. And then there is a solar-led growth, one more line which has come. They were targeting sustainable double-digit growths, right, annually. And the profitability expected to expand significantly. They were again zero debt. There was strategic focus on premiumization, solar being brought in as a new thing. So basically category expansions. And the key growth drivers were solar EPC, new categories which are being brought, and premium appliances which were being brought. So again, if you see, the recommendations move towards buy. because there is a strengthened balance sheet, new growth vectors are happening, etc. So the market also sees this, and they are able to take a call that this is a time when you can, how their views change over different periods of the company's history in a journey. That is what I wanted to point out here. So if you look at the investment thesis for DN, it has evolved in phases. In 16, it was a newly demerged entity, and the whole thing was about a turnaround play. How the turnaround could make it more valuable. So the value could go up, right? But by 24, though the company had done well, there is a huge debt pressure on him, the company. And there were also some issues with the integration which were going on. So it was more a cautious recommendation of hold. But having come out of all this, again, it has become a very compelling buy scenario, right? The debt is settled. There is cash flow, positive cash flow, which is happening with no debt to service. Also, there is money available for investment. There is a solar EPC business which is being entered into. Premium products have been introduced, etc. So there is a huge positive which is seen at this point. Now let's look at one by one various case scenarios and how decisions were taken. The first scenario is revolving around strategic financial management. DNs made a strategic decision to acquire 75% in Carnatic for approximately 2,000 crores. This acquisition was funded through debt. By mid 2025, the company successfully repaid the entire amount, transitioning to a zero debt status. Now, the question here we need to look at is how did this decision to take on debt for the acquisition and then aggressively repay it impact the company's capital structure and financial risk? What does the return to zero debt signal about its future financial strategy? The second question is, as per Ind AS 36 impairment of assets, what factors should company consider when assessing the value of goodwill and other intangibles arising from Carnatic acquisition? We saw that 2,000 crore was a huge price to pay for acquiring this company, which they paid. So when they paid such a huge price to acquire it and they have acquired it, then obviously every year there has to be testing for impairment, especially because there will be goodwill and there may be other intangibles also which needs to be evaluated. So there, that is the second point. So let's look at. So the first one is on the impact on capital structure and financial risk. The acquisition initially shifted the company's capital structure from being low leverage to having significant debt. So the debt equity ratio was skyrocketing. Obviously, it leads to increased financial risk because there is a higher fixed interest cost which will be there. There is a repayment pressure which will be there. All that, right? But the moment they were doing this aggressive repayment of the entire debt, it completely reversed it to the other side by showing that you could repay 2,000 crores in a 3 year period or less than 3 year period window. You have not only become zero debt, you are saying that there is further cash coming from my system, which I can go towards investing. So it is a significantly positive signal there. So, with that, what happens is there is a huge possibility for the future to have financial flexibility. What all can be looked at? The company is free now to look at reinvesting aggressively in organic growth, like R&D, marketing, solar, or pursue strategic opportunities without the burden of existing debt. So you can go in even acquire one more company, because you don't need debt, you are having your own cash flows coming. Build a strong buffer against market volatility so that your credit worthiness and resilience to risk becomes significant. So these are various things coming. So just to give you an aside, you all might remember that that WhatsApp was bought by. So when that happened, what was the thing? They paid a portion, significant portion of cash, which was only 1 year's cash flow from that company. So the amount, when you look at it, it was some 19 billion, if I remember right. Out of that 19 billion, only 4 billion was by cash, balance was by stock swap. So that 4 billion of cash is just 1 year's cash flow, net cash flow for that company. So the acquisition, though it looks like a huge acquisition, very difficult to buy it, etc., for their size it becomes easy. So when you want to now go and acquire some company, another 2000 crore company you want to acquire, you can just acquire without even batting an eyelid. So your opportunity to grow and scale up becomes significantly improved. Coming to the second part on the Ind AS and impairment of assets. Now, DING may have to annually test goodwill and some of the intangibles like the brand for impairment. What are the key considerations which have to be there? Identification of CGU, right? As they had decided to keep it as a separate brand and separate this thing, so maybe it has to be done for Carnatic, right? The company must determine the appropriate level at which test for impairment should be done, whether Carnatic should be a separate CGU or it should be part of the larger kitchen appliances CGU, meaning DN also had, Deccan also had its own kitchen appliances division. Original idea was to merge these and make it into a single thing, but that didn't happen for various reasons. So first and foremost, they should evaluate whether these two should be seen together or separately, because it is how you operate which is important to look at. Then they should look at the recoverable amount, which to be calculated as the fair value less cost to sell and value in use. Now, what is fair value less cost to sell? Here, there are no big assets which you can sell and realize, or there are no quotes which are available for the business as a whole to sell. So, the fair value of selling this is not easily going to come up, right? So, what you normally work on is the value in use. So, the value in use, how do you do it? Value in use is okay. Today, this business is being used like this or run like this. So, on that basis, what can it have a value? Whether that covers my goodwill. Now, for this calculation, there has to be future cash flow projections which have to be made. Then they have to be discounted. For future cash flow projections, then there are key assumptions which will be there about revenue growth rate. You can't have your own mind about whatever rate you want to put there. It's an Excel sheet, right? There has to be rationale for the revenue growth, what kind of market share you can get, and what kind of margin improvements which you can get. So all this will need to be very clearly, carefully uh, computed, considered, and then the projections have to be made. And they have to also look at indicators of impairment. They should continuously monitor if there is any underperformance. There are budgets, and if Carnatic is not performing as per budget, then there is a concern whether that will continue into the future also, whether that is going to have an impact on whatever projections you are taking for the purpose of arriving at value in use. So should that be revised? And if it is revised, would it lead to any impairment? The second is any slowdown in the market, or in this case, as they had integration issues. So if you, some of the integration issues may lead to some anticipated synergies not happening. So if that happens, then what happens? You are also losing out. You will not get the kind of cash flows which you had projected. So how do you address that? The next is about strategic cost management. When it became independent, right, they ran a multi-year cost saving program. Now here the focus is, how did the focus on cost management separate from the previous conglomerate structure contribute to company's successful turnaround? How does the company balance its cost discipline with the need to invest heavily in innovation and premiumization? So one side you are saying you are going to heavily invest on innovation, R&D, etc. On the other side, control cost, right? So how do you balance that? So let's look at the what has been done, right? The intense focus on cost saving was the primary engine of the turnaround, right? It addressed the years of underinvestments and operational slack. So what I was telling you, I am the profit making entity in the whole business group conglomerate. I am feeding everybody else, so I become slack, because anyway I am not getting anything, I am not doing some big growth, etc. The money is being used for building other businesses, so I become slack. So if I tighten and make another 100 crores, that's not going to help me build my business. It's going to go to some other part of the conglomerate to build some other business. So these are human mentalities, how it works, and how corporations also tend to degenerate. This led to direct boost to profitability of 1,000 crores in the first 5 years. So it made a reasonably profitable company to a very good profitable company. Then, by these savings itself, you have found money to invest into R&D, marketing, brand building, etc. Then it also leads to the culture changing. Like I told you, there is a significant slack which builds in, and lethargy which builds in. So now the company started becoming having a performance culture. So these were the things which were the key contributions there. And how do you balance cost discipline with growth investment, right? So this is what earlier also I said, concept of sharp capital allocation decisions. The first one is cost excellence must be there. Just because you are profitable doesn't mean you can let go some part of the profit for slack. That has to be an excellence. Then you go and spend it on something else, right? So you cannot give slack. Say, for example, because I am doing very well and profitability is good, I can't just keep giving discounts to the customer. If the product can command the premium, instead of giving discounts, I should command that premium, take that money, go and invest. So I find some more innovative product. Both are passing on back to the market. Ultimately, I may make only the same amount of margins, but how you use it makes a significant difference. Just by giving a discount, it's not going to dent the market, especially where the premium features are felt. So rather you go and spend it on something which would give new products, etc., which would not only reach the customer better, but also provide for your continued presence and growth. So that is how you make operational excellence as an habit on one side and targeted high ROI investments on the other side, like the R&D spends, etc. And later the solar project which they looked at. So coming again, so I said margin delivery should be a discipline. It is not just because I am making margin, I can give up another 10%, 20%. It's chordo. We are still making good money. That should not be the approach. Coming to compliance and governance, being a public listed entity, right? The demerger of the consumer business was a complex material event that required meticulous compliance. As per SEBI LODR regulations, what were companies' disclosure obligations surrounding the scheme, right, for demerger? The company operates under a professional management structure with no identified promoter. How can strong internal controls and audit frameworks under Companies Act enhance governance and investor confidence in such a structure? Let's look at these two. The demerger would have triggered a detailed disclosure and approval process. What are all the things? Filing of the draft scheme that is required. And there has to be disclosure of rationale, why that merger is being done. There must be a fairness opinion for the valuation for the demerger. Then there has to be shareholder communication very clearly, right? All material details being given under Section 230 to the shareholders. And then after the approvals, again updating stock exchanges because you are a listed entity. So these are the things which should have come up. How better governance can be brought in a professionally managed company with no single promoter. First and foremost, the directors take responsibility and they have to give in the annual report the adequacy and effectiveness of internal financial controls, right? So it is the director's responsibility to provide internal financial controls. Then a powerful independent audit committee is also to be there and it can oversee financial reporting, internal audit functions, and related party transactions. And especially because there is no single promoter, the audit committee will have a very strong play and they will be able to look at these things to add value to the whole governance process. And a risk management committee for larger companies and listed companies, there is necessary mandatory risk management committee is required, which has to identify the various risks the company has and what assessment they have made about it, what kind of mitigation steps they are to take, etc. So these are the ways by which they could address the governance, enhanced governance in a professional setup. Okay, there are some few MCQ questions also. After that, probably after this session, we'll take a small break and then reassemble for the second case study. Very short break we will take. So in mid-2025, Dieng announced the full repayment of 2,000 crores of debt it had taken for Carnatic acquisition. The transition to a zero debt status is significant because it immediately increases the company's ROCE, reduces financial risk, and provides greater flexibility for future strategic investments. It is mandatory under SEBI LODR regulations for all listed entities or triggers an impairment test for all required assets. So what can it be? Now, let's look at the answer. It essentially reduces financial risk and provides greater flexibility for future strategic investment because your continuous cash flow now is free and available and you have become zero debt. In the recent quarter, Dieng's ECD segment contributed 72% of revenue, lighting contributed 14%, and Carnatic contributed 15%. What does this revenue mix indicate about company's business strategy? The company is overly dependent on lighting segment for growth. The company has a balanced yet focused portfolio with ECD as the core and Carnatic strengthening its presence in kitchen appliances. The company plans to divest its lighting business due to its low contribution. Carnatic's revenue contribution is too small to be strategically important. Now, what do you think could be the reading from this? The actual reading should be, see, if you remember, the company was 100% ECD, then it became ECD and lighting. Now, obviously, Carnatic cannot just come and say, okay, now I'll be 50% contributor. So, the company has a balanced yet focused portfolio with ECD as the core and Carnatic strengthening its presence. Assume it was not there, you will be 15% less or even more, right? Because sometimes people come and get connected things bought together. So, this is the focus there. And next is Deng's acquisition of Carnatic, a leading South India kitchen appliances brand, is best categorized as what? Forward integration, vertical integration, horizontal integration, or a conglomerate diversification. Now, here, a forward integration means you are going on to some value added product from your product. A vertical integration means you are going either to a supplier and tying up with you because you are already a B2C, right? A horizontal integration is increasing the portfolio in the same broad segment. Our broad segment is what? Consumers, household requirements. So, from a broader this thing of consumer electrical and appliance sector, we have by taking Carnatic, we have added more. So, it's a horizontal integration. Deng's strategic priority of portfolio premiumization involves shifting its product mix towards high-end design-led offerings. Which of the following metrics would be most direct indicators of the success of this strategy? Right? Portfolio premiumization involves shifting its product mix towards high-end design-led offerings. So, what will be the most appropriate direct indicator of success? A decrease in company's debt to equity ratio, an increase in company's overall market share in the mass market segment, an improvement in the company's average selling price and EBITDA margin, a reduction in the number of products in its portfolio. Now, here, if you see an improvement in company's average selling price and EBITDA margin, what am I doing? I am selling fans, I am selling better fans, so I am supposed to get a better price. My average selling price should go up. My margin should also go up. When I do premiumization, what does it mean? I should get better returns. Not only better sales price, but also better returns. So, am I getting those two? Or what would be the most direct indicator? I think the last question we need to look at is this. If the company's ROAS is greater than cost of capital, what does this indicate? The company is destroying shareholder value. The company's earnings are not sufficient to cover its interest payments. The company is creating economic value and generating returns. The company has a very high debt to equity ratio. Now we are saying ROAS is greater than cost of capital, right? So when the ROAS is greater than cost of capital, what happens? Your value goes up because you are getting 20% return. The market is only expecting 15% return, so you get a value up. The company is creating economic value and generating return above investor expectations, right? So with this, we are coming to the end of the first session, and I suggest that we take a short 10-minute break. Now the time is 7:50. Sharp 8 o'clock, we will reassemble to take the next case study. Yeah, thank you. 10 minutes is on. Yeah. Let me share the second presentation and then. Yeah, good evening once again. Now we can look at the second case study for the day. The second case study is basically our dessert for the day. It's a sweet shop. How the sweet shop became a QSR powerhouse is what we are going to look at from the learnings from Coastal Cravings. That's the name of the entity which does this. Now, this Coastal Cravings was formed in the 1980s, about nearly 45, 50 years back, by a father with his sons, and it earned a name for being authentic South Indian sweets and savories. Now, it was started as a sweets and savory shop. That's how it was started, and it earned a good name with that Coastal Cravings name, and also for its good quality products. They were very focused on delivering not only quality products but hygienic and at the same time fairly priced traditional delicacies. So the idea was to grow that sweet shop. Now, essentially, they were well known for their Mysore Pak, Laddu, and savory snacks. That is typical traditional South Indian sweets or Tamil Nadu sweets, basically. The company's early success was all because of its commitment to the traditional recipes so that people really found the taste to be good, uh, like made at home and things like that, and consistent quality. And they had a deep understanding of the local palate, so they ensured that they are meeting the expectations of the customers with only focus on savories and sweets, and that too mostly sweets and savories from the Tamil Nadu region. Now, nearly a decade later, there came a opportunistic position, and there was a significant strategic opportunity which they had to look at. The sweet shop by then was very stable, but the brand had limited visibility and it had intense competition from other established players. It's not, there are so many sweet shops. So the leadership really recognized at that time that if they had to really build a long lasting brand, they need to evolve beyond just being a sweet shop. So they took a pivotal shift and the company ventured into restaurant business in the second decade of their launch. So they called it as the C2, C square, right? Coastal Cravings was the sweet shop name. So they made it C square to make it catchy. It was started as a fast food restaurant in Trichy. So they first wanted to test out in a smaller town, Trichy, and then think of how to do with that. This pivotal shift really made a huge change in the whole company and transformed the business from being a traditional sweet shop to a modern QSR chain. Today, a company stands as a regional powerhouse with 1,500 crores turnover and over 170 outlets across India and some internationally, but largely in the south of India. Right? That's how they have grown because there's a huge countries to grow across is a big task, big ask, right? So, what was the business model? There was a significant synergy between its heritage as sweets and savories retailer and its modern avatar as a quick service restaurant chain, QSR chain. This dual format strategy allowed it to cater to different consumption occasions for purchasing packaged snacks for home or to dine out with the family. Both were now being catered to. The core operations are streamlined to enhance efficiency, quality, and consistency, which was the brand's promise from day one. So, what did they do? They started centralized production. Now, in mostly in the restaurants, everything is prepared in house in that restaurant. But this company decided to go on a different approach by centralizing many things which are to be done in a large scale. So the company adopted a asset efficient. So this makes it also asset efficient. Why? Because I don't need to replicate the equipments everywhere for every single thing I'm going to do. Because many of the things I'm going to centralize. So it is more efficient usage of the assets. It operates a few large modern factories where all products are made using standardized recipes and processes. This strategy ensures that Mysore Pak or a packet of mixtures tastes identical whether purchased in a store in Chennai or a highway outlet in Karnataka. Anywhere you buy, you get the same taste, everything, because it's all standardized and produced en masse, not produced in different parts separately. As I told you, they were initially to doing only Tamil Nadu snacks. That's where they started. So they started developing. Product development was the next line. They started developing, right? The company offers a vast array of traditional Tamil Nadu snacks, successfully filling niche for authentic flavors that cannot be bought from other national brands, right? Easily. So that is where they were becoming one up. Simultaneously, in the restaurant menu, they introduce popular South Indian staples like idli, dosa, vada. Again, focuses on consistency and hygiene, standardization, bringing in some centralization wherever it is feasible, etc. Then, marketing and distributions are another sharp strategic focus area. The company's retail outlets serve as its primary distribution channel for packaged foods. So they were doing two things. They were running the QSR restaurant and also selling the packaged products from the same place. That is the sweet, savories, everything. So this created a huge cross-selling opportunity. People who come to buy packed stuff, they also end up having some snacks, quick snacks, etc. to eat. Those who came to eat also ended up buying some of the packed products to take home with them. So this was one big cross-selling which was being done there. So the focus was on trying to build regional brand loyalty and ensure that they are one up compared to any national brand on that, so that they have their place. People eat, people choose food products based on the taste, palate, etc., than just the brand. So it's very important to get there. Simultaneously, it also did the third thing. It aggressively embraced digital channels with food aggregators because that is additional sales which will be going on. People don't even come to you, they order from anywhere online and they get it, and you are getting significant additional orders. So nearly 20% of its sales was coming from Swiggy and Zomato. So this is how they moved and made it into a multi-pronged approach to distribute. So, in this whole trajectory of growth, what strategic decision makings were involved and how it happened? For the first one is the pivot to restaurants. Now, this is one of the most strategic decision. All these days, there were a sweet shop. Now, from being a sweet shop to becoming a restaurant was a significant thought process. They had clearly recognized how limited it is if it's a sweet shop, and people do have to come to the sweet shop, buy it, especially in those days, and carry it with them. Whereas by making a restaurant there, QSR, there is significant increase in footfall also. So they were not looking at it as just an additional revenue stream. It was looked at as a transformation of the brand. The brand, which was called as Coastal Cravings, known as a sweet shop, they wanted to make it known as a Coastal Cravings food. That's it. So it gave multiple this thing. One, C2 made the brand much more visible. The restaurant attracted higher footfalls, and all this led to additional sales of the packed products also, sweets also. The second was a transit driven expansion. So they focused on a growth strategy to put up, because this was a QSR chain, please understand, quick service restaurant. So wherever there is a 5 footfall transit zone, they targeted those. For instance, bus terminals and railway terminals across Tamil Nadu. Then Chennai Metro and MRTS stations. Then intercity highway rest stops or fuel station corridors. So you go on the highway, people do stop somewhere. There you put this. By doing it like that, it started replacing unbranded and standalone entities, because as travelers go, they will always remember, oh, C2, I have eaten in Trichy. Now I see this as I'm going driving down to Bangalore. Okay, I can go and eat there instead of going to some unknown single outlet names, which I'm not sure about. So there was much more um, footfall which was coming and much more change of customers coming. So they were literally replacing some of these restaurants on the various locations because of this. And they had a standardized look, right? They had clean restaurants. So they focused on all the things which would attract the customers and also make it well known. With this, what they do is they started expansion. Now they are a well-known brand, right? And they are in 170 shops are there where restaurant service is done, and also packed products are sold. Now they went into the distribution and said, hey, this packed products are available to distribute through the retail. So they ultimately now have about 125,000 retail shops through which it is also sold, in addition to online delivery, etc. So, what was purely a sweet shop, because they created it into a QSR and in the process established a well known brand which is widely known and prevalent, they expanded that QSR, because of which again the sweets also started selling more sweets and savories. And with that brand name, they were able to start retailing across, which is a significant move. Even in the north, we all know of brands which have done significantly like this, which again has the same this thing. You have today huge amounts being sold by them in the retail also because of the brand name which has been created already. Now, what were the challenges and how did they respond to these various things? Now, the first one is the intense competition and market gaps which were there. In the early days, the market was dominated by other established players, especially in markets like Bangalore, right? The existing eateries offered undifferentiated, often low quality food. Very many were there. Now, this company was creating a niche, consistent quality, authentic taste. So in Bangalore, for instance, it simply succeeded by making soft, fluffy idlis and well prepared dosas with a decent chutney and sambar, which was not easily available. Soft, fluffy idlis and well prepared dosas with a consistent quality and authentic taste across. So they started replacing some of the small outlets, not the big branch, but the small outlets. So over a period, they started getting this visibility as a reliable, hygienic place to go and eat. And then as they progressed into highways, etc., this grew significantly. How to manage rapid growth? The company suddenly was growing significantly, right? It faced challenge of maintaining quality and controlling costs. Margins in food business are to be very, very carefully, tightly controlled, otherwise it can go out of absolute control, go absolutely out of control, right? So what they did was what they did was they maintained a very disciplined approach to operations and retained control over core activities by avoiding a pure franchisee model and preferred company owned outlets or revenue sharing arrangements with landlords. So they said the business is mine, I will run it, company owned outlets. Either I will buy the building or rent the building and run it, or I will take the place on lease on a revenue share to him, but I will run the business so that I know that I am keeping tight control and quality, everything. My own operations are fully under my control. Franchise management to have consistency requires certain other aspects, like some of the other chains do that also, but that's a different approach. They took a different approach. So by having our own entities everywhere, it ensured tight control over quality and employee training. Because we know that institutional knowledge is what is being used for training and taking it forward. To manage costs, 1 second, I think I will have to break. Hello, sorry for the small break there. And so to manage costs, it was relying on the high volume sales which was happening, right? And always ensuring that scale was critical for the profitability. So wherever possible, they were centralizing, they were building on scales, and then having it done, only the balance done in each restaurants, etc. Third was professionalizing a family business for the future. Now, this was started by a father with two sons. And now the company was looking at a growth plan for a revenue of 10,000 crores, potential IPO, etc. The company necessarily needed to transition from a family setup to a more professionally managed organization. So what has been happening? We saw it started in 80s, so 45 years, nearly 50 years. So the third generation of the family is being formally trained in various business functions from finance to food science. This is to ensure that there is continuity of promoter interest on one side. Simultaneously, the company was also engaging external advisors to help raise private equity funds. Because when private equity funds come, it's not only money, but they bring in professional expertise and governance structures so that it can put the company in a well structured organization for it to look at a IPO, etc. in future. So many companies which are family driven, when it goes into the second or third generation, there is by then they also grow significantly. There is a huge need for them to bring in professional managers and to bring in a professional structure to the organization's operations. Because as a owner, you're always used to having your one word as the last word. But in a professional organization, you need to ensure that there is a professional approach to every decision being made, etc. So you need changes from various this thing. So looking at the market position and outlook, how it has changed over the period. In 10 years back, they were steady growth from core sweets and some restaurant business. They were doing it. Then about in FY19, maybe 7, 8 years back, they had doubled their revenue by then and continued expansion of outlets. Restaurant business now contributes 50% of the revenue. By 24, they have again doubled their business and they have become a dominant regional player. Now, packaged snacks segment contributes 150 crores because they are supplying through various retailers also. FY26 and in the future, they are targeting a 10,000 crore turnover for in a 5-year plan, expanding from the 170 outlets or so, which I was talking about, to 400, 500 outlets, and scaling packaged good. They are already selling through 125,000 retailers. With that 125,000 retailers, you can increase the quantity as well as increase the number of retailers you are reaching out. So this is the massive growth plan which is being worked on. So it has a well-known position today in South Indian vegetarian QSR and snacks market. It operates with a powerful one region, many formats model, successfully having dine-in QSR, transit retail, packaged goods, right? Like that, wherever as it is more suitable, appropriate outlet types. The outlet type you have in a highway could be different from how you have in a bus stand or a railway station to inside the city. So the formats, everything changes. They have multiple formats to meet the needs, but all the goods, etc., are coming from a common pipeline. From a financial perspective, they are done 1,500 crore revenue and a EBITDA of 100 crores. Now they are looking to raise significant private equity funding with a valuation of around 3,500 crores before going for IPO. So, as I was mentioning, they are looking to open 400 to 500 outlets. While they are doing that, they still want to expand the packaged snacks sales, more sales through the digital and quick commerce channels. Then increase the dominance in the regional food business. On the company side, they also want to ensure they go move on to more professional governance so that they are in a position to manage this kind of a size and growth. So some specific cases we look at in this. The first scenario is Coastal Cravings has long followed a strategy of centralized production for its sweets and savories, manufacturing them in a few large factories before distributing them to its numerous retail and restaurant outlets. Now, as it plans to scale from 170 to say 400, 500 outlets, it's evaluating whether to continue with this model or move to a more decentralized kitchen fresh approach for each location. So the questions are: how does centralized production model contribute to the company's strategic cost management and quality control? What are the potential risks and challenges of this centralized model as a company embarks on its ambitious expansion plan? Now, you wanted a centralized kitchen, which worked, but now you want to go 400 outlets. How will it work? Now, what are the impacts of cost management and quality control of a centralized production model? From beginning, this was a cornerstone to the company's strategy. Now, it enabled them to do any economies of scale production. They could buy material in bulk in one place, which would mean they will get better pricing, better delivery terms, everything. And they could do large scale production where asset utilizations could be better. So they could have lower costs, ultimately, lower cost of goods. By having centralized kitchen, they could also bring in consistent quality because it's all made in the similar manner by the same process, same place, everything. The third is at the outlet, there is limited actions they have to do. So operational complexity is limited. So they don't have to deal with production to an extent. So their kitchen can be simple, basic, and the people you employ there can also be of a slightly lower skills. Otherwise, your cost of operations will immediately go up. So the overall operational complexity at the outlets are significantly limited. So if you see many of the chains globally, like if you take McDonald's, KFC, everywhere you go, Pizza Hut, or whatever, not only in India, globally, this is how they had done it. How they have done it, they have said most of the things are centralized. A. B. Whatever needs to be done in the outlet, there is a simple process and they have more or less standardized and streamlined. A, B, C, D, like this you need to do. That's all. So the skill sets required for the individuals are also significantly reduced in the process. So they've made it more like a machine manufacturing than a chef acting. So this is the way things have been changed to ensure that they get better cost management and because you are centralizing you get better inventory management and also less waste. So this is another benefit which you will get from a cost management perspective in a centralized operation. Those are the benefits or the positives of that. But what are the risks and challenges of scaling? Especially if you are going to have everything centralized, risks and challenges of scaling, what are they? Now, The first is increased logistics and distribution costs. Now, as you grow, you expand. India is a large country. As you expand, then what happens is from the central factories, you have to send it to very many places. The costs increase of transporting them, right? And the timeline it takes is also going to increase. This is one. Second is there could be supply chain bottlenecks. So there is a very heavy dependence on the few central factories. So if some central factory is affected, there are multiple outlets which can get impacted. It's not like that, 400 restaurants, all 400 have their own manufacturing, everything separately. In which case, even if one manufacturing location is affected, flooded, let's say, one flooded, all the other 350 which are in other cities will run. Now, if the central facility is affected, maybe three states will go out of the business because they can't supply. So these kind of things could come. Of course, there are methods of looking at how to deal with such things. Risks always means there could be some mitigation and how far you will mitigate, etc. to look at. Then the third thing is more a Indian perception also that freshly made. Now, when it is manufactured elsewhere and then it is heated up and given and things like that, there is this feeling that it is not freshly made. The centrally produced items surely take time to reach the customer, ultimate consumer. So that is another concern which needs to be addressed. The fourth is the demand forecasting complexity. So with the ever growing network of 400 outlets and 500 outlets, forecasting demand, sending material across various, this thing becomes another major critical issue, especially of food items which have limited shelf life. Even packed food item has limited shelf life. Shelf life. So that is another area of concern which comes, which needs to be addressed. So these are the risks which needs to be also considered when you look at doing something. The second scenario we are going to look at in the journey is the brand and market management. Coastal Craving has built its brand by becoming synonymous with high quality, hygienic South Indian food, particularly in transit hubs like railway stations, highways, etc. A national competitor with a strong pan India presence is now attempting to increase its footprint in the south. Obviously, you will have competition, right? Without competition, how will any business run? So there will be competition. Now, how has the company's focus on transit driven locations contributed to its brand building and competitive moat protection? Is a hyper local regional focus always the ideal strategy, or when does it make sense for a brand like this to diversify its geographic presence significantly? So today they are still very regional. Even their products are very regional. So obviously their customer focus is also very regional, right? So that is also something we need to look at. How to, when it makes sense for them to look at a much bigger market. So let's look at the transit strategy to brand and moat. By placing yourself in bus stands, railway station, metros, etc., there is a very high frequency brand exposure. Even if people don't buy, people commuting through that see. There is a huge amount of daily brand recall which is happening. So the moment somewhere something is required, one of the names which will pop up in your mind is the C2. So this was the significant benefit which was coming from that high frequency brand exposure. Then building trust in an untrusted category. Now we all know, at least if not all the young kids who are there on the call now, all those who have spent 10, 20 years of traveling will all know that highway dining was very, very questionable in the past. Many a times there was no good option which was available. By the C Square name and the option of clean, trusted alternative which they had brought out, the company not only captured the market but also built great brand equity because it was directly addressing the pain point which was being felt time and again. The third one is the regional champion mode. Now, by being very, very focused on the local Tamil tastes and addressing that in your products, they ensured that it is not easy for somebody else to come and take a tap at it. Ultimately, all connoisseurs, all people who eat food will always first go for the right taste and this thing. That's high on the priority anyway. So, for some other brand to come and take this would be a significant difficulty because this would be known for the regional taste. So, this is a big protection barrier or an entry barrier for other players to easily come. If they had just taken to any sweets and savories like multiple pan India sweets and savories as their brand, etc., and they had tried to do this, then they would have been in a significant position where there could be significantly vulnerable position. But having built that brand with a focus on regional tastes and regional this thing, it is difficult to break that barrier. So by going into the transit hubs, significant brand exposure, building great trust in the brand, and also by going in for the specific local tastes, they built significant moat against any other party entering easily. So, in this context, when does geographic expansion make sense? Right? Now, of course, regional focus is the source of the strength. You can't lose that. But diversification beyond the core region becomes a logical strategic move. When does it do that? When the home market shows signs of saturation. Now, okay, you have done 400, 500 outlets. You are still able to do it within the same region. Fine. Then what do you do? The growth will inevitably slow or start falling unless you find newer markets. Otherwise, you will stagnate at a certain level. So that is when probably it might make sense. Then the second is synergistic opportunities. Like instead of trying to go pan India, can you sell in international markets where large Tamil diasporas are there? So going there, it does multiple things. It enhances the brand equity significantly, and there is a captive audience there who crave for authentic tastes. So there is a huge market, better margins, and because of that brand equity, your brand equity in India will also get further strengthened. The next thing to look at is national platform for packaged goods, not as QSR restaurant, but as packaged goods. The company's packaged snacks are already sold in 125,000 retail shops. That can be expanded. Every part of India, there will be some retail shops which would take it. It may not it may not have the same amount of market share in other regions, but what will happen is it will have a share in the right retail shops where again there are target customers pan India. So which is another thing which can come from this. Then the last is regional risks. Over dependence on a single risk obviously gives the risk of something happening in that region has an impact significantly on the company. So geographic diversification will help in that manner also, but this has to be balanced and seen which are the ones you can actually look at and take. From a governance and future funding perspective, coastal cravings were preparing for the next phase of growth, right? So it's also in the process of raising 1,200 crore from private equity investors. Then look at IPO in 5 years' time. So this is a significant shift from the past when it was purely a family-run business. So what are the key compliances and disclosure obligations that they will have to deal with from a SEBI perspective? Then how can the introduction of private equity investors and independent directors strengthen the governance framework? So these are things we will look at. So from a preparation for listing perspective, right, the company should have a clear policy on materiality, and anything which is material events happening, there should be disclosures making. This may include events like new outlet launches. Every single outlet may not be, but if it is a new region, let's say, it could be significant material. Any strategic acquisitions they make, any key changes in management, all this could be material information which may require disclosures. Now, in the past, as family-run business, when you are opening new outlets, you are not required to make disclosures to anyone, so you may not have these compliances run. Then the second is financial disclosures to have quarterly figures which are given, annual figures which are given, very strict timelines are there, right? So which requires that you are a very good and efficient accounting system and team in place. So this is another thing which will be required. All these days you may not have had to look at it because you were only preparing the accounts after the company's year end was done and etc. And the management style would have been different. They wouldn't have been managing based on a P&L balance sheet. They would have been managing based on certain other key parameters. So there is a significant change which may have to come in. Related party transaction, especially given that it's a family business, it's quite possible over a period there are multitude of related party entities from which transactions are happening, etc. So in a listed company environment, there has to be very stringent governance requirement with regard to all these transactions, and the audit committee has to ensure that everything is done at arm's length and to the uh, they have to protect the minority shareholders' interests in the whole process. So related party transactions would be one key area which needs to be addressed when you are going for a listing. Corporate governance report addressing all the aspects of corporate governance and committees being formed, actions which are taken, minutes, meetings which are held, etc., to be reported in detail. So that is also another thing which will come. And then the last is shareholding pattern. Not only shareholding pattern, but any movement in stakes held by the promoters, etc. So all that will have to be reported periodically. The governance and how it can be strengthened with a PE or independent directors coming in. There is a requirement for audit committee which will come up, and the audit committee will mostly have independent directors. So that will oversee the key things like financial reporting, internal controls, appointment of auditors, etc. So that is one major thing. Actually go far beyond just the founding family members to ensure that there is a much more balanced oversight on the governance aspects of the entity. The P investors coming in will push for getting experienced professionals in key management roles to ensure that the family's domain expertise is also supported with professional management skills in various areas for better management of the company, and also ensure that there is well structured management and reduce the risk of any founder driven decisions. Now, as long as it's my own company, I take decisions, and if some decision goes wrong, okay, fine, I work for that and go to the next step. But in a large entity which has so many stakeholders, my decision cannot be the final because it could have impact on so many. So there has to be some checks and balances which are brought in to ensure that I am also advised better to take better decisions, or when I am taking some wrong decision, I am advised well in time to change that. So that is the key thing there. Of course, internal controls. There is basically a board's responsibility which will come up, and a risk management committee will have to be framed if it is listed. Then that also will have to play a role in the management of the whole company's operations. Now we will look at some of the MCQs on this also, and then probably we'll have a little time for some general questions you may have from Gupta ji to give advice on about the paper, etc. also. So let's go into the MCQs one by one. In FY24, Coastal Cravings reported a revenue of approximately 1,500 crore and an EBITDA of around 100 crore. What was its approximate EBITDA margin? Was it 5.7, 6.7, 10, or 15? Now we all know EBITDA margin is EBITDA by revenue. Here it is 100 by 100 and 1,500. 1,500, if you take it, it's 1 of 1/15th, 6.67, which is close to 6.7. So B is the right answer. This thin margin highlights the company's strategic focus on high volume to drive overall profitability. This is a common characteristic in food and retail business. So the EBITDA margin is only 6.67%. In fact, sometimes it could be even lower than this. And this is EBITDA, not PBT or PAT. So you have to do huge sales to make some money. That is what it is. Volume game, right? And very tight control on the margins. Coastal Cravings' strategic decision to set up restaurants alongside its sweet shops in the early 2000s is a classic example of what? So they were trying to set up a restaurant alongside the sweet shop. Backward integration, product diversification and cross selling, market penetration, vertical integration. Now, if you look at it, the correct answer is product diversification and cross selling. So what were we doing? We already were selling sweets and savories. We now also want to sell other food which you can eat there. Product diversification and also cross selling. People who come to eat foods will also buy sweets. People who will come to buy sweets may also have some snacks and go. So either way, you are doing some cross selling there. In the context of this, backward integration is if I were running sweet shops and then I go and set up supply chain, whatever was there to the sweet shop, if I integrate that, then that is backward integration, right? So I am running a sweet shop. For that sweet shop, I am running a manufacturing facility, and the biggest thing I am consuming is base and flour, etc. So then I also set up a flour mill. Then that is backward integration. Market penetration is to reach out into the market. Now, by setting up a QSR, you are not doing market penetration, you are only expanding your variety and maybe attracting more customers. Vertical integration is going in the chain upwards, right? So, either with this, you do a integration of your, for example, the same way we were talking about um, something which is supplying to you. So you have a tie-up with a farm, you have a tie-up with a sugar mill, etc. Those kind of things could be coming in there because that is the maximum which you are using. A dairy for ghee. The third is looking at the company's strategy of placing its outlets in Chennai's metro and on national highways is primarily aimed at what? Reducing its real estate costs, capturing high frequency customer traffic and building brand familiarity, competing directly with national package snack brands, testing new menu items. Now, which is the main thing here in terms of placing the outlets in metro stations and highways, etc.? The answer is capturing high frequency customer traffic and building brand familiarity. So, because of the large volume of people who pass through the metro stations, even those who are not buying will see there is a brand building which is getting done. Significant exposure you are getting to the brand, right? So, this builds the required thing for the sales to enhance. That is what we are achieving in this process. Based on the case study, what is the primary risk associated with coastal cravings? Centralized production model as it plans to expand to 400 plus outlets. So, which is the primary risk in the centralized production model when you are expanding to 400 outlets? A significant increase in raw material costs, the increased complexity and cost of distribution to a wider network, difficulty in recruiting staff for new outlets, increased competition from local players. Now, here we are talking about the primary risk in this centralized production model. So obviously it is not D or C, which is more to do with the outlets. Significant increase in raw material cost will not be the case, because actually it can be reduction in because of economic of sale, it could be further reduction could be possible, but the increased complexity and cost of distribution could be the key thing, because now your outlets are going to be 400, means it's going to be even wider network. So you need to have humongous logistics planning done to ensure that this is being reached all across the larger geographical area which you need to cover. And here we are also dealing with products which are perishable comparatively earlier. So that is the major focus risk there in this case. Then the last question is on Coastal Cravings' targeted valuation for its upcoming fundraise is about 3,500 crore on a projected revenue of 1,500 crores. Its revenue multiple is approximately 2.33 times. If its net profit margin is 5%, what would be its PE ratio at this valuation? So, what will be the PE ratio at this valuation? Right, let's look at the. So, the correct answer is 46.6. So, let's see how. First, let's see what is the net profit. Net profit is 5% of the revenue. 1,500 crores into 5% is 75 crores. The valuation which is being looked at is 3,500 crores. So 3,500 crores by 75 crores of profit gives you a 46.67 times. So this is the multiple, very high multiple. This shows that despite the thin margins, the company's strong brand, growth prospects, and market position command a high valuation multiple. A very high valuation multiple which is being commanded in the normal course. Of course, each case we need to see differently, but this is also something which comes out from that. Now, with this, we are basically coming to the end of the two case studies. So, if there are any questions, we can take that. And Gupta ji can also give some specific advices on the paper.
Students, on behalf of everyone, sir, on behalf of everyone here, I would like to sincerely thank you for taking out your time from busy schedule. We truly appreciate the way you explain the regulations, laws, financial reporting regulation, as well as strategic issues. Your examples made it clear that real business decisions are not about one subject alone, but about considering the decisions in a holistic manner. That is exactly the IBS paper is designed to teach us, to connect knowledge from different areas and apply in practice. Sir, your insights have given us clarity and confidence, and we are grateful for your guidance. Thank you so much, sir. Now, students, if you have any questions, please ask now. Sir, you may leave. If you want to leave, you may leave, sir. Thank you, sir. Students, now I am guiding you about how to handle MCQs. Okay. In this IBS paper, MCQs are designed to test your understanding, application, and professional judgment through different MCQs format rather than simply memorization. Each format requires a slightly different way of thinking. There may be a situation where multiple correct answer MCQs. More than one option may be correct, so each option must be evaluated independently. For example, a question may ask which of the following sources for competitive advantage. Okay, option may include cost leadership, product differentiation, strong brand reputation, or high employee turnover. There may be multiple combination of these four statements. Now you have to identify correct statement, combination of correct statements. This you can identify only when you have at least basic conceptual understanding. First, try to find out correct options and always use elimination rule in MCQs. Okay, here we know that there are three correct options. First, source of competitive advantage is low cost strategy, cost leadership. Second is product differentiation, where we try to create unique value. And third, strong brand reputation. All three are source of competitive advantage. And high employee turnover is not related with anywhere from it is not aligned with this MCQ. It can be clearly eliminated. Now you have to think about other three options, and if you have good conceptual understanding you can easily identify these three A, B, C or 1, 2, 3 whichever are the correct options. Second type of MCQ may be assertion or reasoning based MCQ. You may be given two statements, okay, and must judge their correctness and the logical connection. There will be some connection between these two statements. Assertion for and now I am trying to give you one example. Assertion. Suppose a firm achieves competitive advantage by offering lower price than competitors. Firm wants to create competitive advantage through offering lower price. Reason suppose they have given you reason lower cost allow firms to maintain profitability even at lower prices. Now here you have to decide whether both statements are true or whether the reason is correct explanation of the assertion. Okay, there may be another third type of MCQ. This is not type of MCQ. Students, again I am repeating, if you have conceptual understanding, good conceptual understanding, you can easily handle this MCQ also. Again, you have to eliminate incorrect option. Now when you will eliminate incorrect option means you have incorrect options are your answer. For example, which of the following is not a way to attain a competitive advantage? Number one, continuous improving operational efficiency. Second, investing in brand loyalty. Third is ignoring customer feedback. Fourth is innovating product features. Now the MCQ is indirect. Again, I am repeating again. Which of the following is not a way of sustaining competitive advantage? Not. It means identify which are ways. Okay. Continuous improvement in operational efficiency is a way towards obtaining operational efficiency. Second, investing in brand loyalty or branding, it is it is source of competitive advantage. Third, ignoring customer feedback, it is not a source of competitive advantage. And fourth, innovating product features, it is again a source of competitive advantage. It means out of four, one option, that is ignoring customer feedback, is incorrect or not answer. Then then you have to select this option. Therefore, I suggest you to read MCQs very carefully, especially not type of MCQs. These MCQs are very simple, but you have to read the requirement of MCQs very clearly. Don't get panic from note type of MCQs. These MCQs may be integrated with multiple options type MCQs, as I suggested earlier in first type of MCQ. Okay, you may get good control over solving MCQs, but to gain this control you have to do practice, practice, practice. You have to solve a number of multiple choice questions. Fourth one type is most likely MCQ, where more than one option may seem reasonable, but here you have to choose best correct answer. For example, a customer wants to maintain differentiation advantage in competitive market. Which strategy is most likely to succeed in this case? First option is reducing production cost at the expense of quality. Second is enhancing unique features valued by customers. Second is copying competitors' product to save R&D cost. And fourth one is offering discounts across your all product lines. The most appropriate answer is enhancing unique features valued by customers, as this aligns with sustaining differentiation advantage. At the same time, other options are also similar, like reducing production cost at the expense of quality, but enhancing unique features valued by customers, copying competitors' product to save R&D cost, offering discount across all product lines. All out of all four, few options are similar. There you have to identify most appropriate option, and most appropriate option, as I just told you, this is enhancing unique feature by which is valued by the customers. Sometimes offering discount across all product lines are also valued by customers. But since questions requirement is most appropriate, then most appropriate is enhancing unique features. Here you have to properly identify. These examples show that MCQs test how well you apply the concepts, analyze scenarios, and make informed decisions rather than simply recalling definitions. Students, why an index is crucial in open book exam? Any type of open book exam, indexing is very important. Why it is important? It saves your valuable time. In time-bound examination, searching through hundreds of pages for a specific concept, provision, or standard wastes your precious time. A well-organized index allows you to instantly locate at right material, such as Index 115. Where is Index 115 in your module or in your other book? Similarly, Rule 9A of Income Tax Act. This relates to film production cost. Similarly, Section 149, it relates to director's disqualification. Same time, index also supports strategic application. Students, please note, this exam doesn't test your ability to find information. They test how you have to apply. Having an index helps you to quickly move from concepts to application. But understand, it is not substitute of conceptual understanding. You can successfully apply index only when you have good conceptual understanding. It is not substitute of good conceptual understanding. Open book resources and indexing will support you only if you have good conceptual understanding. Otherwise, you will end up with wasting of your time only. Without an index, you may sometimes get panic where a provisional rule is written. With an index, you free up your mind on focus, analysis, and integration. Having a index, having a reliable index means you are not relying on memory under pressure. You can believe on your preparations. But again I am saying this is not substitute of your mind. The best mind map is your conceptual understanding. Sometimes students use mind map which is prepared by their friends, colleagues, so on. But again, best index is one which is prepared by you from your own mindset. Now, students, use the time initial reading time in a systematic manner. I always say students, start by going through requirement part. Identify ones you are most comfortable with. This will help you in better time management. Question selection is very important. A wrong selection in beginning can waste your time, affect your ability to attempt full paper properly. While reading a case study, jot down your key points based on questions requirement. For example, if a question is related with Index 41, marks or note down important words, figures, underline keywords, paragraphs, sentences. This early step is very important. I call this as sketch making. You may need to refer the study material during the exam, but here index will help you, and best index is your mind. Sometimes students create their own index to navigate quickly. I have also told you just a few minutes back. That's fine. But the best index is your mind. If your concepts are clear, you can scroll and find you need efficiently. If not, you may end up with wasting of your time and even finding the right content. For example, in past exam there was one question on ECB norms. Students who had studied the concept could refer quickly and apply it. Others spent too much time on looking and still couldn't apply it well, affecting the rest of the paper. This exam is not hunting about answers. It is about how well you understand and apply the concepts correctly. Again, open book resources index will help you only when you have conceptual understanding. Start answering on the left hand side page. This gives you right hand page for rough work or calculations if required. Always attempt all required questions. Make sure cover all parts of the paper. Even brief answer can fetch marks. Students normally face the issue in set A and set B. Students, I sincerely request you, all of you, to take them seriously. You know, Set A covers corporate and economic laws. In today's context, where corporate failures are increasingly reported, corporate governance becomes highly relevant. Questions based on this topic are generally simple and can be connected with any case studies. If the company is listed, then SEBI LODR question can be easily connected. If company is having foreign operations, then it can be connected with AFM Forex chapter, custom duty indirect taxation, as well as FEMA. Think from this perspective. Overall, you can expect around 15 to 20 marks paper from this area. If your concepts are clear, answering them won't be difficult. Set B focuses on strategic models like McKinsey 7S, value chain, corporate failures, balanced scorecard. Students, these models are very easy. These models form base for decision making and often tested in various scenarios. It is as advisable to practice how to apply strategic models. Don't try to memorize. You have to apply. Creating a mind map of key strategic models and their application is very useful in examination. Again, a solid conceptual understanding of both sets is essential. See past trend of your examination. Currently, ICAI is testing around 35 marks questions from this portion. Therefore, you cannot ignore this. Try to practice module questions. Believe believe that set A and set B will help you to score your marks 60 plus. Students, if you have any query, you may ask. Otherwise, I am winding up this session. Okay. To all our students who joined today, thank you for your active participation. Let us today's session remind us the IBS is not just about solving case study, it is about connecting theoretical knowledge with practical knowledge like decision maker, CEO, CFO, auditor. Whether you are dealing with FEMA, taxation, accounting standards, finance, business strategy, or any advisory role, it is opportunity to connect the dots and apply your knowledge in real situations. Keep learning, keep exploring, and most importantly, keep practicing. This paper is nothing but a proper planning and proper strategy. Go ahead in exam with proper planning and strategy. I'm sure you will surely get 60 plus marks in this examination. Wishing you all the very best. Once again, a big thank you to TV Bala sir and to everyone who joined with us today. Thank you everyone. Session over. Good night.